Hey, good morning, everyone. I'm Alex Green. I'm co-founder and chief evangelist of Globacap. At Globacap, we've digitized and automated the underlying processes behind private capital, which is enabling a suite of tools to help you better engage and manage your investor network. Alongside myself today, we have an expert panel including Rod Bristow, who's the CEO of Investable, and Jatin Ondya, he's CEO and founder of Shojin. So thank you both, gentlemen, for your time this morning and participating. Really appreciate it. And I think we'll start off here with Rod. If you'd like to please introduce yourself and let everyone know a little bit more about Investable.
Thank you, Alex, and thank you for the opportunity to join and have a conversation today. I'll give you a little of my background personally, very briefly, and then talk about Investable. I've been working for 30 years now, and first 10 years of that was in natural resource management and then management consulting with a global firm, and the last 20 years in financial services, where some of the roles I've performed include Chief Operating Officer and alternate Managing Director of Australia's largest retail stockbroker, and then over into the asset management and wealth management sector. And I was approached to join Investable a couple of years ago now, just over a couple of years ago now, and really, a lot of the genesis of the interest in this opportunity was about working with a couple of incredible founders who've got a great story, but the sheer weight of opportunity behind private markets is significant. I've had a personal investment thesis for a long time that listed markets, particularly large cap listed markets, will mean revert, and alpha generation is too difficult. And so the ability to really generate alpha is going to come from private markets, and we're already seeing that with significant weight of capital flow. And so Investable started, our two co-founders exited a business successfully pre-GFC and then started investing initially through a syndicate and then formalized Investable in 2014. And since then, we still have our syndicate, and our model is that we have early stage VC funds that co-invests alongside our syndicate. And so we have the ability to be able to bring two entities, two founders on the cap table, a fund and a syndicate as one entity, which adds a lot of value. And then our syndicate members obviously can support founders with capital post-investment. So we invest at pre-seed to Series A. Our investment process and methodology is very much data driven, and we also index very heavily on the founder. So we're searching for those very rare founders who have a high degree of EQ, have a very strong and passionate connection to the problem, but then also have built or can demonstrate to us that they can build very robust businesses. So we've deployed more than 120 investments now across 9 countries in 20 sectors. We typically invest in around 1 in 100 that we review, and we will, inside our funds, we'll construct a portfolio of 30 to 50 companies. First check is normally 500K to 1.5 million, and then we'll follow on in the best of those companies inside the fund. And this methodology has proven to be reasonably successful so far. We, in our 3 funds that we're operating, soon to be 4 funds, our next fund will be launched out of Singapore next month. And we operate here in Sydney, where I'm based, and also in Singapore. So nearly 30 team members in our 2 offices, really sourcing, screening, securing, and supporting those founders to be successful.
Excellent. Well, thanks very much, Jatin. And introduce yourself and talk to us a little bit about Shojin, please. Thank you.
Sure. So thanks for the opportunity to be here today. So my own background is investment banking. So I spent about 12 years with UBS Investment Bank, and we launched Shojin in 2009 because we realized that I was always invested in real estate. Alongside my full-time job, I was always invested in real estate on the side, as was my co-founder. And over the years, we kept getting asked from professionals, wealthy professionals, asking how we were doing that. And, it wasn't rocket science. But what we started to realize was actually there's a lot of very smart people out there with money they want to invest into real estate. They recognize that it makes sense to invest in real estate because mainstream markets, exactly as Rod said earlier, it's really hard to generate alpha. And in real estate, you've got a much more effectively inefficient market. so you can actually generate outsized returns. So everybody should have some capital allocated to real estate. And so many people kept asking us if they could invest with us. We just decided, all right, you know what, let's just set this up as a business because there's something here. So we started off by really bringing investors on board when we were doing investing into high yielding properties. My co-founder's background was construction, so we swiftly moved into renovation projects and then full-blown development projects. And while doing this, we would open this up to our investor base to invest alongside us. The idea being that we're going to do it anyway. Whoever wants to join us can. And because of my financial background, I could package the whole thing up into a very simple way for people to understand what the upsides are, what the downsides are, and so on. That model really, really took off. But actually, the real change came around 2015 when we realized that in the UK market, there was a huge untapped opportunity. And that was very simply providing funding to mid-market real estate developers. Because like any business, when they start off as a developer, they're doing small projects, they get money from the bank. If they need extra cash, they go to friends and family. But as they start doing larger projects, they outgrow their own networks. And good developers are not natural capital raisers. So that was the opportunity. We said, bring us your project, we'll go through it, we'll apply our own due diligence process. If it makes sense, if it's a kind of project we would do, we'll provide whatever additional funding you need. And then, you'd always borrow from the bank because that's cheapest, the senior funding. And then we would go in with mezzanine funding. We could also go in with equity funding. And what this meant was that a very, very good developer, if he's doing a £10 million project, let's say the bank gives him £6.5 million, the developer would need to have £3.5 million. Most normal business people are not sitting on that much cash. So it meant that a good developer could identify a good project and actually do the project with a fraction of that capital. And then we would go in as partners. If we go in as equity, we might share the profits, or we might do a fixed return product. On the other side, we also realized that investors love this product because traditionally, most investors have not been able to access the development market. That's been the preserve of the super wealthy. So now what we could do is effectively, if we're providing £5 million, we could break it into smaller pieces and everyone can invest. And so that's what drove us to become FCA regulated in the UK and launch this as a digital platform where we could actually reduce the minimum investment all the way down to £5,000 and really open this up to a global market where we see our core market is what I call global mass affluent. Eventually we'll get to low-level retail, but for now there's a huge untapped market of investors with a few £100,000 to a few £1 million. They're not family offices, they don't have access to these kind of things. So that's our core market right now. It's probably quite similar to Rod, to what you guys are doing.
Well, thanks, Judson, and thanks, Rod, and both sound like really interesting propositions. You guys are doing definitely great strategies. Both, though, like everything else in cap markets and in the investment space, comes with a lot of administrative burden around it. It's around distributing and offering, around engaging with all these investors, managing multiple structures and all this stuff. So, we certainly feel that pain point on our side at GlobalCap, and one of the reasons that we began our journey 5 years ago to solve some of these pain points. So GlobalCap is a global capital markets ecosystem. We have software solutions that allow you to manage placement activity, issuance, then the digital registry of vehicles. It's a multi-asset platform. We are a tech provider, but then we also are a regulated entity in its own right, and we can step in as an operational service provider at times. And we carry authorizations as a custodian in the UK, and we then also have an arranging license as we arrange our investments and transactions. A broker-dealer license, Rod, arranging licenses. It's a very specific license over here in the UK. On our platform, we currently have $14 billion worth of, that is the market value of securities that are in our digital registry, or the digital registry tools at GlobalCap. We've processed over 42 private placements, so origination events. And in the secondary liquidity, we have settled $180 million worth of secondary liquidity on GlobalCap's platform, and that's from a private issuer-led structure. 11 white labels we signed up to just a couple of days ago, so we now have 13 white labels to institutions, and started in 2017. So your platform's great, amazing ideas, really great strategies, both of them, providing access to pockets of liquidity for people that perhaps would struggle there. But there are a lot of administrative issues, a lot of processes that need to be followed, and the three of us were all doing it in a very regulated environment, and there's a lot of rules then to follow. So those can lead to a lot of cost in running a business and complying with those. So we look to, I think everybody's looking to streamline and become more efficient. Today, we're going to be talking about the settlement aspect specifically, but I want to start off quickly at the distribution. So I think it probably makes more sense to talk about how where the settlement activity begins, and that's from putting an offering together, and then let's talk about the pain around distributing an offering, and then driving that investor engagement that then leads to that book build process, and then actually then subscription process, and then settling the transaction, and then what that means. So why don't we start off with distributing offering, and let's just talk about your thoughts individually. So how you target it, targeting the correct investors, onboarding them, gathering the essential information that's required. What are the tools you guys use right now? And maybe just your views real quickly on both of them. We can start off with Rod, perhaps in this one, and then move over to John and get your views as well, please.
Yeah, thanks, Alex. I think it's fair to say, I mean, we're an emerging VC manager. We're managing, about 120 mil US now. So we're still very, very small in the scheme of global alternatives managers. But I think that, that tailwind I mentioned before, I think Preqin have done the analysis that showed that at the end of last year, the end of 21, there was 13.3 trillion in assets in alternatives, and they're predicting that to grow to all effectively to double over the next 5 years. And so I think really significant tailwinds behind this sector. But I think, as we all know on this webinar, the technology that is going to enable and deliver that is just not there. And so when you look at distribution, our business grew out of essentially a syndicate of high net worth investors, and so our strongest connections are with investors who everyone has a slightly different definition of high net worth, of course, globally, but our high net worth investors here are defined as a certain way, and so we have a strong syndicate. We raise from that group of people. We've done quite a bit of work with the wealth management industry here in Australia, both local and international names around raising capital. And also some family offices and a couple of foundations, ironically, out of the US. Our business is transitioning towards raising capital from the institutional market. I think, as your viewers are probably aware, the Australian superannuation industry is one of the largest in the world, and so that's another tailwind behind raising capital. However, and there is a however, the process is extraordinarily painful, and so working with a high net worth investor, talking around why would a high net worth investor or any other investor for that matter want to consider alternatives as part of their asset allocation in the portfolio. There's an education process there, and then assuming that the investor says, yes, we'd like to engage, that's where the real pain point actually starts. So, AML, KYC in particular, while we do have some automated tools, it's still fairly clunky. Cross-jurisdictional issues as well make that more complex. So that onboarding process, if you think about it, I think in business we often make the mistake of thinking from the inside out. I always encourage our team to think from the outside in. And if you're dealing with an investor who might be worth $50, $100 million, and you have convinced them that alternatives is a great way to go, and then you put them through a very, very painful and intrusive process around gathering data and information that is really sensitive, and it can be challenging for the relationship, might be a polite way of putting it. So I think there's definitely a need to improve that, and what you positioned, Alex, and also Jackson, you started talking about around essentially democratization of the asset class. This is just the hygiene factors around being able to have conversations that someone of that ilk would expect you to be having in a mature way.
Yeah. I mean, it's kind of interesting. Optimizing the investor journey is absolutely crucial, and the thing is, there are a lot of pain points for both us and for investors, and really our job is to find how to make that as seamless as possible. But the reality is, I don't think anyone's cracked it yet. Now, when you get these platforms, for example, that can raise £50 at a time, actually you'll find people invest I mean, I've done it myself. I'll go into Seeders and Crowdcube, see something that just looks interesting, stick a couple of £100 in, because you know what? It's a punt. It's a pure punt. But with our market, we target the mass affluent. While our minimum is 5K, the average investment per transaction per investor is actually about 25K. So it's a slightly different demographic. Now, when someone's looking to deploy that kind of money, they're not going to do it on a whim. They're not just going to take a punt. They want to know what they're dealing with. And that's where things actually start becoming interesting. So we kind of break things into these 4 stages, filling the funnel, nurturing the funnel, transacting, and then keeping engaged after transacting. And what we find is each one has its own challenges. Oddly enough, I find once we've got people in the funnel and we're nurturing the funnel, once people decide they want to transact, actually the process becomes much easier, because a lot of it's then automated, right? You've got the KYC AML is done through the platform, the payment process, everything is done through the platform. So what we find is that it's in the earlier stages where the challenges are. Now, filling the funnel with anyone is easy, but filling the funnel with the right kind of investors who genuinely aren't going to be wasting our time. I mean, obviously, a lot of our marketing is automated, but there is this point where it crosses between digital to traditional, where if someone's going to drop £100,000 into a project, chances are they want to have a phone call or they want to have a meeting. Once they've done that, they'll do everything through the platform. But the challenge is knowing at that stage how serious they are, and therefore how much time is spent offline dealing with them. Because the holy grail here, which we all know, is the ultimate digitization means actually never talking to an investor physically. Now, that's not to say we don't want to talk to them. We're always happy to talk to them, but the process works if you never actually have to take it offline. So that's, I think, the biggest challenge everybody faces. And then with all the KYC AML stuff, I think the investor base that we deal with, certainly, I'd say 90% of them don't grumble, because they know it's just the way of the world nowadays. So all the extra AML checks we might have to do, everyone just accepts it. That's the way it is now.
Okay, excellent. Well, thanks both. And Jatin, I think it's really interesting where you finished is kind of a really good segue into the next part, is like just driving the investor engagement aspect. And I agree with you. My past life at JP Citi and JP Morgan, it was that I had to figure out how interested Rod would be, how interested Jatin would be, and keeping notes on that and feeding that back into people in the organization. And we're building the book for the IPO, and then I'm going back to you guys constantly. If I had a platform back then that could do it on my platform, I could run many more deals or much more efficiently, or like you said, lower the touch points, not eliminating the touch points with the client, because there are points I believe that you need to engage with that client, but lowering those, making the process more efficient, giving them full access to the information. So maybe we could talk about that, and I guess Jatin, continue on yours, and then Rod, about how you manage that. And because I think that's the important part. Like, without that, we can't get into settlement, because if they're not getting the right information and they're not comfortable with it, well, they're not going to get into the book.
Yep.
Yeah, absolutely spot on. I mean, look, we use a combination. We're trying to optimize our use of technology. So we use HubSpot, and we try to use a lot of the features within HubSpot to have, when people first register, they go on an automated educational journey to really understand more about our products and what that means. We hold webinars with Q&As, all the fun stuff. So we have all of that, but then as we say, you've got this kind of offline element where what we find is it's kind of geographically different. For example, we have investors in the Far East who are very happy to go up to about 25, 30K, never speak to us. They'll attend a number of webinars if required. They'll get themselves comfortable. They might ask questions on the webinar, but that's it. They'll then go ahead and transact. Whereas we find in some other places, a bit more of that personal contact is essential. So in the UK, it's probably half and half, but in places like India and East Africa, it requires the relationship. So the way we're dealing with that is actually by going a little bit old school and having relationship people on the ground who can actually meet up with them. They share the culture, so they can, go visit, they can sit down, have a conversation. But the beauty of that is when it works well, that one meeting for 1 hour actually unlocks that investor, and then they go on to do a number of transactions through the platform. So it is a little bit of a hybrid.
Yeah, ours is as you can probably imagine, still very much relationship focused. It's, you know, the commodity that we're exchanging is trust. And so, you know, you can't exchange that commodity in the absence of being able to build that trust over a period of time, over a number of engagements, over all of the interactions that our organisation's having with both current and potential investors. And so that, you know, our team, our sort of, you know, client engagement team are on the ground working with our current investors and also working with potential investors on a daily basis, you know, interacting regularly. And so now, of course, you know, you have CRM tools, and those CRM tools have improved significantly over time. You know, we're not the style of business that can you know, Jatin described that great process there to walk people through an educational process. We can't really do that. Our clients don't respond to that. They really need that face-to-face touch. So that's how we've kind of, I guess, organised our engagement at the front end. And as I talk about it, it's a contact sport.
Rod, do you guys have like a team of relationship managers then who effectively go out and engage with clients? Yeah,
we do, and you know, we're you know, we're not a typical VC. We're not actually a general partner business. We're a corporate model, and so we have a more traditional corporate structure. And so between our co-founders, myself, our senior executive team, and our BD team, we're all working on that together. And you know, that is really, it's a tried and true approach, and everyone brings a slightly different sort of emphasis to it. And so we sort of spend quite a bit of time on making sure that we're allocating segments and sort of matching the right conversation to the right person in the business as well. But we have, across the business now, I think we have around about 450 limited partners, as well as our syndicate of another 150 members. So collectively, we have around 600 touch points now with individual investors. So it's taken on a life of its own, which is a separate conversation around administration.
But the beauty is your quality as a result would be very, very strong because you personally vetted each one. So that's the benefit of doing it kind of old school, if you like.
You know how it works though, Jatin, is I can't put that asset on the balance sheet. So.
But even that quality that you said, Rod, and you were alluding to it, and then perhaps you were going to expand on it, said, well, that comes with its own administrative pain as well, right? Because if you have those 600 different touch points, even if they're high quality investors, well, then you still have a lot of data and a lot of orders, a lot of indications of interest to manage and all that, and that's what goes into this whole settlement process, right? And like what we're looking to do is we're not, at least here at GlobalCap, we don't remove that human element. You can remove it as much as you need to for your organization, but it's about bringing the people into one place so that way you can see all the documents you need to in one place, like what Jatin talked about, making that process a lot easier for the investor. But then also it allows you to protect yourselves. So this is something you guys have to manage when you're managing that subscription process. How can I confirm that Rod and Jatin saw all the information that they need to see at the right time that they need to see it? So that then the way they subscribe, we can manage that. But then if you're managing an order book, Rod, of 600 different people, well, that's a nightmare of its own. So maybe we can go there and talk about that, managing the subscription process. So how do you guys then actually do that, manage that, taking everything from that indication of interest? And then do you start there? Do you have anchor investors? Then do you open up the book for like the, you know, strike at the money type offerings, take it or leave it, accept the terms or don't? You know, we see clients that have varying needs and requirements on our end.
Yeah.
So, Rob, maybe we start with you this time, yeah.
Yeah, we're pretty sort of boring and predictable when it comes to that side of things in terms of, you know, the first close, second close, final close type model when it comes to our fund products. So we'll go out, engage with potential investors and use some technology, you know, initially sort of, you know, due diligence technology through something as simple as DocSend, so we can kind of track who's looking at what in real time and link that into the CRM process. And when it comes to subscriptions, you know, we have a service provider that we've engaged, and, you know, interestingly, they're separate service providers in the two different markets that we work in as well. So, you know, our own internal team works closely with those service providers to make sure that at the time where we're ready to essentially, you know, implement a close, we're engaging with everyone through that technology. But it still requires a lot of manual intervention, and I think, the pain point for me is there's the obvious pain point, I think, around just the sheer volume of transactional work that's going on and the risk of human error that goes with that. But it also, for me, the point that I spoke about before around trust, that every interaction that we have with one of our current or potential investors is another sort of pave in the road around that really building trust with our business. And if those interactions don't meet their expectations, then they may be an investor in this product, but they may not invest in future. And so, that's really, I guess that's the way we look at all of the work that we're doing in analysing the potential for improved efficiency and systemization. Is it's not just about operational efficiency, it's actually about making sure that when people come to us, what they're getting is true to label in terms of the quality of the experience.
Right.
It's quite interesting you say that, because so if you go back kind of 10, 15 years, this type of kind of fractional model just couldn't have worked, because the administration would have completely killed us all off. And then everyone started moving, adopting some sort of technology with things like, DocuSigns and all of that, which made life a little bit easier, but it has its own kind of issues as well. But weirdly enough, what we have found is actually the entire administration process is now dealt with through technology. But what you find is, especially with larger investors, like, your HNWs typically will be people like myself, kind of, I don't want to use the word middle age, so let's just say 40 to 60 is probably a core demographic. And they're initially they still have this kind of slight reluctance to kind of do everything. Am I going to send £100,000 through this online platform? They're not sure, so they might require a little bit of hand holding. But actually, what we find is, once they do it the first time, and if they require hand holding, then we do that. But once they do it the first time, they actually love it. It's like, I don't know, the first time you used digital banking or Uber or whatever, there might have been certain reluctance, but then once you see how easy the process is, actually they love it, and then they finally get it. They see why this is the future. So I think there is an education process, but a lot of it is driven by the demographic. When we're dealing with a 30-year-old, on the other hand, they have no issues. They get it.
I imagine if you go down to an 8-year-old, they're probably even more technologically.
Exactly. They'll be teaching us, yeah.
So let's talk about the difficulties then. Okay, we have the investors on. You target them. We got the information that they need. Now they're in the data room, whatever it is that you're using. You're using DocuSign. You're using different tools. How are you guys managing that process about taking those indications, or actually the actual subscriptions, and then building those order books, and then managing those order books? This is like pre-settlement here. So let's finalize the order book, and now we have to issue. It
was a colossal pain in the backside, if I'm to be honest, because just because you have this order book or indications of interest with amounts, it almost becomes meaningless, because when the time to transact comes, anything can change. Yep. What we actually ended up doing, and we realized our single biggest issue is, and it's slightly different to, I guess, what you're doing, Rod, and I guess what a lot of people raising through the GlobalCap platform do. But with ours, because we're in real estate, there is a fixed deadline for completion, because all the legal completion happens. But the developer has exchanged contracts on the basis that we're coming in at the point of completion. Now, when we start raising money, if we haven't raised money on that date, tough, we've still got to fund it, which means in the old days, we used to start our raise earlier and hope that we'd raised enough. And if we hadn't, we'd be phoning up some of our bigger investors saying, please, can you put some more money into this? But really, it was the wrong way to do it, because what if the deal drags out? People's money is just sitting there, right? Or you can't scale a model by having to call people at the last minute saying, can you invest some more money? Then we started this book building type approach, right, where we'd ask for expressions of interest much earlier on in the process, and then we wouldn't launch it till later, because you have to wait until a certain point to launch it, because by then you've done the due diligence. But again, we found that a lot changed from their initial indication to the actual time that we're asking for them to go ahead with their investment. So in the end, we've settled on something much, much simpler basis, what the investment banks sometimes do as well, right? Which is you underwrite the deal. And you underwrite the deal by bringing in, so we've now got some heavyweight family office backers who basically realized that was our single biggest problem, because we were going to raise equity to have money in the bank to warehouse our own products and then launch them on the platform. And thankfully, these family offices actually turned around and said, you know what, you don't need to sell equity for that. Here's a facility. So that's the way we do it now. We actually have stopped launching projects. And then the moment we've legally completed the funding or whatever, we then, it's warehouse, so we give them the money. We then launch it on the platform, and then it sells in whatever time it sells. The family offices, to their credit, cut a very good deal where they get the full rate of return while they're warehousing it. And then we, as you can imagine, but we then are fully incentivized to sell it down, because then we get a spread. If we're charging 30% and we sell it at 22%, we get the spread. But no money changes hands until the end of the project. So we don't make our money until the end of the project. That's when the family office gets paid as well. So it doesn't hit our cash flows straight away, which was the key thing that we wanted.
Yeah, we're slightly different again, but we typically, when we launch a new fund product, the corporate will essentially make a general partner commitment. So it's not technically underwriting as such, and typically, as a rule of thumb, we will put in 10% of the fund's value as a group, and then that comes from essentially a close-knit group of people who are either our co-founders, management team, and some of our syndicate members as well, who are often shareholders in our holding company also. So that has the same effect, if you like. But I think that's a really interesting model that you've articulated there, Jatin. I think that sounds like it works really well. So that's very clever. I think our book build process is we will work with, as I talked about before, the potential investors, and typically we'll have a two-stage conversation. We'll have a soft commitment conversation. So we'll talk about does this make sense? Does it sounds like it might work in your portfolio? If that were the case, what might you be thinking about in terms of an allocation? So we're getting a sense of what the book would look like. And then as we get closer to essentially the hard start point for the fund, and obviously in the background, our investment team are working hard on matching raise to deployment as closely as we possibly can. But then as we're getting closer to the point where we say, right, the fund commencement date is X, then we'll go back and have a secondary conversation and say, look, thanks very much. Really appreciated your soft commitment, Alex, of X. Are you in a position now where you can confirm a hard commitment, and then we'll actually send out the formal documentation to execute. And then, we'll obviously walk through the capital call structure. So that hard commitment isn't a dollar amount on day one. It is sort of staged through the fund deployment period.
I guess the way that the world I used to live in works as well. What we see is on our platform, we see some clients managing your types of processes and Jatin, others at yours, right? Or actually you can manage different books. So you can have that indication of interest, and then you can say, okay, we're going forward now. Rod, reconfirm that you want, yes or no. And then you actually get like the actual settlement process docs issued to you there. So you can manage, you have flexibility to manage that settlement, because this is what's necessary, right? And Jatin, maybe in some deals in the future, you might have different structures as you can then grow, and your offering can grow and evolve and scale. And I imagine it will, as you start to get into the institutional world, it's going to be a different animal. And there are going to be different requirements. There are going to be different structures that you're using that they might not be comfortable with this one. They're going to want the family office return.
Yeah. Yes, I'm sure they will. But Rod, do you guys ever get a situation where you say to a company you're going to raise X, and then for whatever reason you haven't got enough commitments for that? What happens? Like, I know with seeders and stuff, the deal falls through. I mean, is that the case?
No, so because we're raising in the funds, then it basically is a unitized structure, and so it all goes into that pooled structure, and so then the deployment is done at fund level. So so that kind of manages for that risk. But you're right though, it's a great question, because through the syndicate though, so if an opportunity comes through the fund, then the funds team will obviously undertake the due diligence and make a recommendation to the fund investment committee, and they'll make the decision on whether or not the the fund decides to invest. If the fund does decide to invest and there's room on the cap table and the founder is interested, then we will take it out to the syndicate for co-investment. And often, syndicate members might be former, global CEOs, or they might be, people who've got a particular affinity for that particular deal. So they might want to co-invest alongside the fund. They'll get access to the DD, but now we don't make any representations either to syndicate members or to the company about any amount that might be raised. But we sort of essentially it's an arranging function, and we're the trustee in the middle that kind of facilitates the transaction.
Right. That makes a lot of sense.
Jatin, how do you settle the transaction? So let's talk about issuer and investor needs, because there's different needs. The issuer, you're talking about, okay, you got to accept the funds, communicate the wiring instructions. Who do you use for escrow? Do you use escrow? Do you use custody accounts? And then settlement. When does that happen? When are you issuing shares and certificates? Both of you are doing the same thing. So at what point does that happen? How quickly? And this is the investor journey. And we've heard of cases where in sophisticated world, people still waiting 3 months for their docs after they've given the money and they're supposedly an investor in a structure, which is not the best for anybody. Then you have to maintain cap tables, you have to maintain registers, maintain transaction records. So I'd like to cover those points here at the end, if you gentlemen don't mind.
Yeah, sure. I mean, again, as we were raising, in the traditional way through the platform, the settlement would happen because the legal completion would happen at a certain point. So an investor would have the money in their user wallet. They'd be putting it into what we call the project wallet. So it's still ring fence in escrow. And then when the lawyers are ready to complete the transaction, that money goes to the lawyers, and then that loan gets made to a developer. On the other side, simultaneously with that money going over, the equity or investment documents are all then kind of released back to the investor to say, this is the start date. Obviously now things are simplified because we warehouse, which means we've already done the borrower side of the transaction. So now it literally is when an investor goes in, they say they want to invest, they put the money into the project, and immediately it will issue all the documentation. So it's actually much more seamless now.
And then you also issue the documentation. And what about you for the issuer side? How are you managing your registries? So have you digitize those completely? Is it integrated into this issuance process as well?
Yeah, that's all done through the platform as well. So it's really simplified. Like I say, I mean, 20 years ago, you couldn't have done this with such, with small investment amounts. But today, it's almost as if we don't care if someone puts in 5K or 500K. It's actually all the same from an admin perspective.
Exactly. Okay. Good. Rod, how about yourselves?
That sounds like utopia to me.
Let's have a conversation after this, Rod, about utopia.
Yeah, I think so. Yeah, definitely. So we're, whether the transaction comes through the fund or through the syndicate, the investment decision is made at fund level. It's done centrally, through the syndicate. It's individual investors, but we manage all of that on their behalf. There's inevitably a term sheet negotiation that leads to long form document negotiation that leads to essentially agreement on terms, cash changing hands post document signature, and then quite a lengthy process of back and forth that often involves cross country, different legal jurisdictions, different regulatory jurisdictions, different investor jurisdictions, different currencies. So our settlement process is very manual, and it can be quite lengthy. And I think it's another one of those pain points where, high net worth investors in particular really just, they want to be able to log on and see where everything is at any point in time. And I think at this point we're not meeting those expectations, I think, as an industry, let alone inside our firm.
Let's talk about that innovation here just at the end and get your guys' views for, obviously, I think we have both of you, Jatin's very innovative, probably down that curve already. He's using a lot of different tech solutions, but you'd like to get your views anyway on where innovation needs to go or the benefits thereof. And then Rod, if you could maybe provide that same type of color of like what you guys are looking to do in terms of like innovate is that from a technological standpoint? And I think from our side, we see that tech allows you to actually innovate the business in many different ways. You can manage multiple structures, different structures, create different kind of asset classes and vehicles for that right client or for that right investor base. And like Jatin said, managing, he doesn't care if he's got a guy in fishing 5 or 500, it doesn't matter. And something at GlowCat, we say we make it as easy to engage, manage 5 and 10 investors as easy as managing 10,000, because you can automate a lot of that ongoing process. Jatin, maybe we can start with you then.
Yeah, absolutely. I mean, look, I'm loving where technology is going, and you know, the great thing I think in today's environment, unlike 20 years ago, you don't have to build everything from scratch. And I think this is what I love. I mean, you know, GlobalCap, for example, provide this, as do others. And you know, there are effectively, the way I look at technology nowadays is it's a bunch of components put together. And the components individually, there are different companies who are optimizing the process continuously. That's all they do. So if you take KYC, AML, you know, there's companies that's all they do. So they give you a plugin and that just takes care of that. You know, the documentation process, the investor engagement or kind of communication process, you know, all of these bits are so readily available out there that my view is that, you know, the next stage of evolution in our markets, you know, yours and ours, is really that whole investor experience. And now, you know, even taking the 40 to 60-year-olds, they are getting more and more not just comfortable with, but actually expecting a more seamless process digitally. So you know, with that in mind, you know, if it's not really smooth from the first time they go in, it kind of puts people off. So I think given what is available off the shelf today, it's a quick win to start integrating that into the process. The other thing, just very quickly, is and I mentioned this to you, Alex, before, is the whole use of open banking. I think that is just absolutely amazing. So yeah, probably looking at implementing more of that.
Excellent, thanks, Jatin. Rod, maybe you can wrap it up then.
Yeah, thanks, Alex. I think the way that I would describe this, I guess, is that, you know, businesses typically solve pain points that are at the front end, that are revenue related first. And I think the problem that creates is a waterfall style problem solving mentality that never finishes. And so I think, you know, when we think about, you know, what are the innovations that we want to introduce into our business, I think it's about, you know, how can we as an asset manager make things easier? Digital solutions that can support distribution, that can help us set up and launch new funds across different jurisdictions, can help us onboard clients efficiently, effectively, cost effectively, with a good experience for the client, can administer those funds effectively, can obviously issue and settle units digitally, and be able to then provide reporting. I think, you know, that's and every business will be different. Some businesses might want all of those components. Some businesses might want to componentize that depending on their particular competitive advantage. But from our perspective, I think really it is end to end. And I think the ability to be able to say to the marketplace, well, here are a set of end to end solutions. You can have the whole, or you can have the sum of the parts, should you choose. I think that's certainly where I think it needs to go.
Well, gentlemen, thank you very much for your time today. It was very interesting, both of you running different types of capital markets businesses, but you know, strategic. And Jatin, thank you very much for your time. Rod as well.